Well, hi folks, it's the Annuity Guy, and I've got a message for high net individuals that want to increase their income. Now, if you need an income today, most financial advisors are going to steer you towards an income rider. They're very popular today, but most financial advisors don't realize there's a better alternative. Income riders have some major drawbacks. The first thing is time. If you want a large income, you're going to delay taking that income to let the account build up. Now, it's kind of a catch-22. If you need an income now, you're going to have a smaller amount. If you want to let that income be larger, you put it off as long as you can, so you've got more money, but you got less time to enjoy it. All right. The second thing is they limit the amount of money that you can take at one time. So not only do you have a time factor, but you have a schedule. For instance, most 65-year-olds, most accounts are going to let you withdraw somewhere about 5%. It depends on how old you are. So if you're 65 years old, they allow you 5%. If you wait till you're 70, it might go up to 5.5%. So yes, it lasts you a lifetime, but it's not a very generous amount that they do give you. The third thing is it depletes the asset. So it never runs out of money. You never outlive your money. However, you're not going to leave much to your heirs. If you draw that income for a long time, you might not have anything in your account to pass on to your heirs. So it actually depletes the actual asset. So I can show you how to generate a larger income and not deplete the asset. Now, let me give you an example of a man named Marvin. He's 77 years old, and he's got an investment portfolio of bonds worth $500,000. And the yield on those bonds is 4.5%, and that means he's drawing an income of $22,500 per year. Now, Marvin wants to leave money to his heirs, but he also wants to increase his income, and we can show him how to do both. Now, we use that $500,000 to buy a medically underwritten pension. Now, what this means, it's a type of an annuity, and it takes a long time because we're going to send medical records off, and it actually takes about a couple months to get quotes from a lot of different insurance companies to make sure you have the best payout. His payout is $60,943 per year for as long as he lives. Now, out of that money, he's going to buy an insurance policy to replace the asset. So he buys a $500,000 life insurance policy, and that premium is $29,159 per year. So Marvin is going to take the pension, and he's going to pay that premium that he receives from that pension. Now, let's take a look at the comparison and show you how this plays out. His gross income before was $22,500. Afterwards, it's $60,943. Before, he had no real insurance, or at least not this one, but now it's going to cost him $29,159. Now, this means his income increased from $22,500 to $31,784. Now, what he had going before was not tax advantage to his heirs. Now it is. He had a large estate, which means the chances are he was only going to leave half of that money to his heirs. And now, because he's got a life insurance policy coming back outside the estate, it will be worth the entire $500,000. So Marvin was able to substantially increase his income and not just avoid depleting the asset, but he got to leave the full asset to his heirs upon his death. Now, this strategy is best for those in retirement and will require medical records to be submitted. Now, the results are going to depend on the age and the health of the client, and it's going to take months to work up a quote. If this strategy interests you, give me a call or visit my website, annuityguide.net, to find out more. This is an amazing strategy, folks. I urge you to take a look at it if you've got a large estate. Thanks for watching. God bless you, and have a great day.